welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll discuss the disinflationary environment and the Fed rate cuts, which are expected widely to occur later this year. This is especially relevant to investors after the inflationary episode of the past few years. Fortunately, the dust is beginning to settle, and it's clear that not only is the so-called soft landing occurring, but inflation is heading back toward 2%. What this means for long-term investors is that staying invested and focusing on the underlying economic trends is still the best way to reach financial goals. Let's take a look at some of the recent economic data. First, this chart shows various inflation measures that economists track. On the left, you can see figures for Consumer Price Index, or CPI. The latest CPI numbers just released for February show that inflation increased 3.2% year over year. While this was a slight uptick from the previous month, this is far below the peak from 9.1% in 2022. The uptick was due to stubborn areas such as shelter, which represents the cost of rent and housing. Excluding this from core CPI results in a growth rate of only 2.2%. In other words, the underlying inflationary trend is very close to 2%, and factors such as shelter and energy prices have kept it high. This is why many economists expect that inflation is headed back toward more normal levels, although it may take some time to get there. Another aspect of inflation that has worried some investors is the growth of the money supply following the pandemic. This is best explained by the economist Milton Friedman's famous line that inflation is always and everywhere a monetary phenomenon. What he meant by this is that when the money supply grows faster than the economy, each dollar is worth less, resulting in inflation. While this view is not agreed upon by all economists, this chart shows that the money supply shrank and has been more stable in recent years. It's possible that this has helped to improve the inflationary environment as well. Finally, this chart shows the market expectations for the federal funds rate over the coming year. The market has changed its expectations multiple times, most recently pushing back the first rate cut from March to June or July. This is more in line with what the Fed has communicated all along. The big picture here is that history suggests that disinflation followed by Fed rate cuts is positive for the markets. The mid-1980s, for instance, which experienced a decline in inflation after the 1970s and early 1980s, paved the way for multiple decades of economic growth and strong market performance. While the past is no guarantee of the future, there are multiple reasons to be positive today as well. We've only scratched the surface on this topic, so please feel free to reach out if you'd like to discuss this any further. We look forward to speaking with you.